Hey guys, welcome back to today's video. Today we're going to be reading something off the motleyfool.com. It's under investing basics on the top and it's called What is the S&P 500 Index by Matthew Frankel. So what is the S&P 500 index? When it comes to the major US stock indexes, the S&P 500 index is the most highly regarded as the barometer of the overall stock market's performance and an indicator of how large corporations are performing. With that in mind, here's what all investors should know about the S&P 500, how it works, how you can invest in it, and why doing so could be a smart move. What is the S&P 500 index? The S&P 500 is a registered trademark of the joint venture S&P Dow Jones Indices. It is a stock index that consists of 500 largest companies in the US and is generally considered the best indicator of how US stocks are performing overall. From another angle, the S&P 500 as an index is a statistical measure of the performance of America's 500 largest stocks. In this context, the S&P 500 is a common benchmark against which portfolio performance can be evaluated. The S&P 500 index is weighted by market capitalization. This means that a company's valuation determines how much influence it has over the index's performance. Each listed company doesn't simply represent 1/500th of the index. Massive companies such as Apple and Amazon have greater impact on the S&P 500 index than relatively smaller companies like General Motors. One key point is that although these are 500 large companies, there's a wide range of valuations. Several of the largest companies in the index have market caps in excess of $2 trillion. This is more than 200 times larger than the smallest S&P 500 companies, which have market caps in the 15 billion ballpark. The value of the S&P 500 index continuously fluctuates throughout the trading day based on performance-weighted market data from the underlying companies. Why use S&P 500? You may be wondering why the S&P 500 is considered so useful as a market and economic indicator. Because the S&P 500 consists of a broad basket of stocks without too many small or obscure companies, it contains the companies most widely owned by individual investors. The 500 companies account for roughly 80% of the overall value of the stock market in the US. Company weighing formula and calculation. The weighing formula for S&P 500 stocks is fairly straightforward. First, the company market cap is determined by multiplying each company's outstanding share count by its current share price. Next, the market cap of all S&P 500 components are added together. Each company's market cap is then divided by a total in order to determine its weight in the index. For example, if the combined market cap of all S&P 500 companies is $40 trillion and one company has 1 trillion market cap, it would make up 2.5% of the index by weight. Which companies are in the S&P 500 index? The S&P 500 index is composed of 505 stocks issued by 500 different companies. There's a difference in numbers because a few S&P 500 component companies issue more than one class of stock. For example, Alphabet Class C and Alphabet Class A stock are both included in the S&P 500 index. Obviously, it wouldn't be practical to list all the S&P 500 companies here, but because the S&P 500 is weighted by market cap, its performance is mostly driven by the performances of the stocks of the largest companies. With that in mind, here's a look at the 10 largest companies in the S&P 500 index as of March 2024. This list and its sequence can probably will change over time. Microsoft, Apple, Nvidia, Amazon, Alphabet, Meta Platforms, Berkshire Hathaway, Eli Lilly and Co., Broadcom, Visa. S&P 500 versus other major indexes. Although the S&P 500 is widely regarded as the best gauge of how the US stock market is doing, there are several other indexes that can be useful for investors as well as including Dow Jones Industrial Average, Nasdaq Composite, Russell 2000, S&P 500 versus Dow Jones Industrial Average. The Dow Jones Industrial Average is a price-weighted index, meaning that the companies with the highest stock prices have the most influence on the index regardless of their valuations. The Dow Jones lists 30 companies and excludes some of the largest stocks in the market. For example, Amazon, Alphabet, and Berkshire Hathaway. Because the Dow is price weighted, Goldman Sachs, with nearly 389 share price currently, has more than six as much influence over the Dow's performance as Walmart's, despite Goldman's market cap being roughly one-fourth of Walmart. For these reasons, S&P 500 is considered by most experts to be a better stock market indicator. S&P 500 versus Nasdaq. The obvious difference between the S&P 500 and the Nasdaq Composite Index is the stocks in the latter must be listed exclusively on the Nasdaq market, and the S&P 500 is a mix of both Nasdaq and New York Stock Exchange stocks. As you can see on the top 10 list, the Nasdaq has a higher proportion of technology stocks on the broader market, so it's more of a tech-heavy index. You may notice that when tech stocks are underperforming, the Nasdaq Composite tends to underperform, and the S&P 500 as well. Another key difference is that while the S&P 500 consists of large cap stocks, the Nasdaq Composite contains all qualified stocks listed on the Nasdaq exchange. Therefore, is more diverse in terms of market caps represented. S&P 500 versus Russell indexes. The Russell indexes are designed to provide benchmarks for the entire stock market. The Russell 1000 is the closest comparison to the S&P 500 since the large cap stock index that consists of 1,000 stocks and is representative of 93% of stock market. There are also more popular Russell 2000 indexes, which is considered to be the best benchmark of how small cap US stocks are doing. Collectively, the Russell 1000 and the Russell 2000 are known as the Russell 3000, which is a broad stock market benchmark index. How can you invest in the S&P 500 index? You can invest in the S&P 500 index by purchasing shares of mutual fund or exchange traded funds or ETFs that passively track the index. These investment vehicles own all the stocks in the S&P 500 index in the proportional weights. The Vanguard S&P 500 ETF, which trades just like stock, and the Vanguard 500 index fund Admiral shares mutual fund are two attractive options. Both have extremely low fees and deliver virtually identical performances to the S&P 500 index over time. In addition, you can buy S&P 500 futures, which trade on the Chicago Mercantile Exchange. These are essentially buy or sell options that enable hedging or speculating on the index future value. Related investment topics. So, if you guys enjoyed today's video, please don't forget to leave a like, comment, and subscribe. It really helps the channel out a lot, and we really do appreciate it. We'll see you guys next time. Bye.